Hello everybody, welcome to this new video. Today I want to talk about Zeta stock. Not the easiest stock to study if you ask me. I'm going to ask two questions. Is it cheap? If so, how cheap is it? And is there enough growth for me? Because as you know, I'm a hyper-growth investor. Is this stock growing enough? Is this sector interesting enough? But the first thing is, what do they do? It's tough to fully understand what they do. They are a marketing cloud. And the answer to that question is, I'm going to say, is they are very similar to the trade desk, because a lot of the players claim to be doing what they do, right? The end of cookies and the arrival of new forms of identifying people, that's the direction of marketing, and that's the direction that it's headed. And so it's tough to try to distinguish Zeta from the rest of the players, being DSP and TTD, the trade desk, being the two other big players in the space. But what makes them special is their ability to target 240 million different consumer profiles. And because of that, they're able to make sure that you target the right person at the right time, at the right moment, and you target them for next to no cost via an email, for example, or a push notification on your phone or a text message, or you target them through cost, through programmatic advertising. That is when you bid for an ad on different websites. On Google, for example, you'll go bid for that ad because you recognize that one customer who's ready to buy, I don't know, that plane ticket or whatever. And as a result of that, you use a system like Zeta to bid on an ad on Google and to make sure that you get the right price at the right time, at the right moment. And of course, you use AI to do all of this. Zeta's a distinction as a marketing cloud. What do they do different? Well, for example, in their email campaign, they're able to reach customers that are presumed customers or would-be buyers, and they're able to highly personalize the emails that they make with AI, and they can send a bunch of emails to people and try to get them to buy something. You can also use an AI, and of course, I presume every modern company in the sector has an AI like this. But you can have a conversation with an AI about your customers, about the campaigns that are possible, and you can craft with the help of an AI, a campaign, or trying to describe the customer, or helping with your marketing, your customer data to design the next product. There's many things you can do with these AIs, and they're only going to get better. And of course, the system allows you to optimize and to do multi-channel ads, multi-channel offers. You can coordinate SMS, push notifications, and email offers, for example. And that's kind of where it's headed. It's about tracking the customers, and they track 240 million consumer profiles. This company is like 98% in the US, so they're all in the US essentially. That's who they're tracking, and so 240 million, that's pretty much all of the adult population in the US. Pretty much anybody who's used a phone in the US or the internet in the US is being tracked by Zeta, and Zeta can advertise to them. And of course, it's all about increasing the ROI of the campaigns, the return on investment on those campaigns. So what do they do? They place relevant ads or relevant messages across the web to potential would-be customers. They show you their big industries. Big industries include travel, retail, right? A lot of clothing. Last year, of course, they had a big political campaign, ads type of things that they do, and this is kind of their positioning in the network. You have Zeta in the middle. You have all of the consumer data where you know everything that your customer is doing, and then you have all of the different ways to reach the customers from the free ways, like like mobile, like WhatsApp, like email. These cost next to nothing to contact, to the more expensive ways to contact the customer, like playing the right ad when they watch, HBO or Netflix or Roku or whatever. That's the middle, right? Zeta tries to be in the middle, and of course that's where the trade desk tries to be as well. Although the trade desk really started as a programmatic advertiser at the beginning, Zeta, and it took me a while to figure that out, but Zeta is also operating a programmatic advertising platform. So Zeta wants you to coordinate the spending on the ads via the Zeta app. So that's where they compete directly. So like I said, AI agents, you can use them for a lot of things like content creation, like campaign optimization. You can use them to analyze your data. You can use AI, for example, to go faster, to iterate faster. You can move faster over your marketing campaigns, do it faster. And of course, a lot like a lot of these apps, what they do is they integrate with other apps, and so you end up having apps which are just APIs on top of APIs on top of APIs. So of course, Zeta is going to coordinate with all of your favorite apps, and it's going to coordinate with different forms of advertising, different like you can Yahoo demand side platform, like Yahoo, for example, as a bidding platform. You can go bid on Yahoo ads to make ads on Yahoo. You can bid on Facebook to do ads on Facebook. And so Zeta is at the center. It analyzes your own website, data about customers, all sorts of stuff. And then it helps you connect to the demand side platform. It helps you connect to all sorts of different systems. And I was reading, can you connect to the trade desk? And so I ended up going into Reddit and stuff and figuring out, like, can you do it? Like, yeah, apparently you can do it using a third-party platform, but they obviously don't want you to do that. Zeta wants you to use their service, or they want you to connect directly to Facebook, because I assume that they make more money that way. So they know who's the competitor, they know who's not the competitor. So anyways, Trade Desk, like I said, is the clear competitor in the space, but that industry is, I mean, when you're not an insider, which I'm totally not an insider, and when you're not passionate about that industry, which I am not passionate about that industry, it's tough for me to really judge. Because I know, at the end of the day, marketing, it's about customer segmentation. It's about targeting the right customers. It's about investing money and creating more sales than the money that you invested. But at the end of the day, it's a lot of advertising, and I'm not sure I find this topic the most interesting topic of all topics. But it's an old sector and it's an old world, and so some companies have been around for a long time. So for example, Google is kind of the standard, and a lot of people in the industry seem to still use Google. And so they acquired a while back a company called AdSense, and now they have a Google marketing solution and a Google campaign manager solution. And Google is at the center of this advertising world. They do a lot of things. They're kind of the granddaddy of this advertising world. But a lot of people criticize Google because Google gives you next to no support. I mean, it gives you no support at all, essentially. Trade Desk is the leader. It's kind of this neutral party that allows you to advertise on Google, advertise on Facebook, and Facebook, I mean all of the Meta properties, right? Helps you to advertise on TVs. And you can see the Trade Desk tries to do it all. They do audience targeting, measurement optimization, they do AI, they do retail stuff, they have the APIs. It's all about the APIs in this world, always programmatic advertising. They do it all. DSP is a stock that I analyzed for this channel in ways back. DSP seems to have a big focus on connected TVs. So connected TVs seems to be the big focus of DSP, and of course they are expanding towards what the Trade Desk does. And so if I were to compare Viant, i.e. DSP, the Trade Desk, and Zeta all together, from what I understand, is Zeta seems to get a lot of praise for messaging campaigns, email campaigns, anything that is based on direct messaging or directly contacting the customer. It seems like Zeta is the best player in that space. Viant seems to be the preferred solution for anything that has to do with connected TVs. And the trade desk seems to be the preferred solution for everything that has to do with programmatic advertising, actually purchasing advertising and getting kind of the best price when you purchase advertising. That is the kind of a feeling that I get. And then you also have the do-it-yourselfers. There's a lot of legacy tools in this industry. And so in the marketing department, if the head of marketing has been around for 25 years, they're going to be using a bunch of legacy tools, and they're going to love these legacy tools. And so that's why you have Google that has a lot of lasting power. Adobe has a system that has lasting power. Salesforce has a system that has lasting power. A lot of legacy companies cohabitate and coexist with these more modern solutions. What gives me pause, though, is when I read about Zeta, I go on Reddit to read on it, a lot of people seem to praise the UI and the UX of Zeta. Zeta gets a lot of praise for being, user-friendly, customer-friendly, and in fact, Zeta advertises on that, saying, most customers did not see, most marketing professionals did not see value in using XYZ DSP platform, and so they seem to get a lot of praise for being easy to use and modern software. And sure enough, I've watched a demo or two preparing for this video, and it looks like a modern day software. It's kind of like the Robin Hood of DSPs, right? It's like, if you use Vanguard's user interface, if you ever use Vanguard user interface, it's a catastrophe compared to Robin Hood's user interface. Well, I am sure in the advertising space, you have user interfaces that still look like Vanguard in some spaces, and they seem to have the most advanced one. And of course, that means you iterate faster, you move faster, you're more committed to the job. So that's enough for the product. Now that we've moved away from the product, let's talk about the valuation. So this is the valuation for Zeta. Look at the EBITDA margin. I'm using their own EBITDA margin that they provided. A cash flow is actually much smaller for them. So I wonder if EBITDA margin actually applies for them. But because this stock is not a bright green flag for me, this stock is kind of stuck in the middle of many other opportunities. I'm not going to analyze it a little deeper, but just keep that in mind. That EBITDA margin 21%. I may be a little bit optimistic on this one, but I'm reusing their data, reusing their number. Forward revenue growth is 24%. Now, to the average investor, this is stunning, right? This is great. But to this channel, at this channel, we do 30% or more. So that's already not very good. And the guidance is going to get actually a little lower. It's just not an industry that grows as fast as some of the other industries I cover on this channel. It just doesn't grow too fast. And I'm a growth investing channel, so I don't like that as much. 24%, that should impress everybody who wants to be in the space, because it's higher than the trade desk at 20%. And it's higher than Viant at 21%. So it's the fastest growing player in this sector. But this sector doesn't grow very fast, right? It doesn't grow nearly as fast as, I don't know, some of the healthcare stocks that I follow, for example. Or some of the banking stocks that I follow, for example. Some of the payment stock even grow faster than that. Go on the spreadsheet if you have access to it, and you'll see this is nothing to write home about. This is not the best growth. So that's point one. But they are the best as far as their growth goes. And because I was so generous with my EBITDA margin on that, which, by the way, I'm not saying it's wrong. It's likely true, but the trade desk has the same margin. So it's profitable. But anyways, 45 is a rule of 40. Enterprise value over gross profit over revenue growth is 0.23, right? And so you can see both Zeta and Viant are much cheaper than the trade desk, right? Zeta and Viant are much cheaper than the trade desk. So you have a lot of people who are going to like Zeta because they want to see that multiple expansion. They're like, well, wait a minute. They have similar numbers to the trade desk. They should be trading at the same ratio as the trade desk, right? So a lot of people will be getting into this stock for multiple expansion. Moving on. So like I said, do I like Zeta? So I told you I praised the AI, the UI, the UX is really good. They're really good for AI email and messaging campaigns. But the reason why I cover it, of course, is I like that it's cheap. If the trade desk were going for the same price as Zeta, I would be going for the trade desk. That's point number one. Point number two, let's look at the stock price. I don't do any chart analysis or anything like that, but they made a lot of money with the presidential election, and you can see the market throughout 2024 bid up the stock, anticipated the spend on the presidential election. Right, and November 8th, presidential election is over. We're 2 days after a presidential election. What do you get? The traders sell the stock, and of course, they've entirely sold the stock. And interesting this pattern. It would be. And the stock hasn't been around for a long time. It'd be interesting to see if the trade desk and all of these advertising platforms tend to go up on presidential years, and in which case you could have a trade. You could be like, okay, well, in 2028, in January 2028, I'm going to get into that stock because I think the market is going to beat it up because of presidential election. So, but aside from that, and of course they've witnessed a drop in spend because of the end of presidential election. But aside from that, the growth, this is the revenue growth, it's been steady. It's been nice. To the regular investor, it's been high. To my type of stocks, it's been meh. It's been okay. Let's talk about the dilution. So as you know, I don't really care about dilution much on this channel. And understandably, because I believe the dollar dilutes faster than Zeta's new shares outstanding get printed. So that's kind of what I believe here. But it's increased. I mean, it hasn't been catastrophic, but it hasn't been good either. It hasn't been flat either. To me, this is not a red flag at all. This is fine, but whatever. A little bit of dilution, that's normal. And they have more cash than debt. It's okay. The debt is not a concern at all for them. It's a well capitalized enterprise, so I wouldn't be worried about that at all. Let's talk about the financials that they report themselves. So they have more customer. Each customer increase quarter after quarter. They get more customers. And then quarter after quarter, these customers spend more on the platform. So more customers spending more on the platform. And so, and you can see year-over-year growth on customer count has been much higher than their modeled numbers. They were expecting 4 to 8% growth in customer count. They got much more. Now, on the other hand, spend per user actually is growing at the lower end of their model, and a lot of that drop may have to do with the end of the presidential campaign. You can see it really clearly in the chart. And they have incentives to grow the bigger customers the most, because the bigger customers, once they're hooked on Zeta, they spend much more money at Zeta. These charts are very similar to any SaaS company. Anytime you see a SaaS company, they will kind of present it like that and talk about how they have XYZ amount of a Fortune 400, and again they can choose Fortune 1000, Fortune 400. If Fortune doesn't fit the narrative, you can say Forbes. There's a bunch of ranking, and then you can say I have XYZ percentage of these companies from this ranking of that or that ranking of companies. Anyways, you're beginning to see a trend, right? So 2 out of 3 of the largest airlines, I know they have United. I was reading one of the case study about United. They probably have Delta or American. I don't know which it is, but they have 2 out of 3, right? Insurance, 5 out of 10, 4 out of 5 of a communication enterprise, tech companies, 6 out of 13. Anyways, you can go ahead and read. They still have some room for growth. The revenue is diversified, and the question is, do we like these industries? I don't know. They're the industries that advertise a lot, right? Selling clothing, you advertise a lot, right? Insurance, that's some of the most common advertisements, some of the most annoying advertisements, if you ask me. Telecom, AT&T, is AT&T better than Verizon? Blah blah blah. Like these ads we've seen millions of times. But anyways, that's the business, right? It's an advertising company at the end of the day. A marketing company, whether you pay for your marketing via email, via TV ad, or whether you don't really pay via a text message, it's still marketing at the end of the day. And the long-term growth, they're guiding 2028, so that's good. 2.1 billion is what they're guiding. That's really, really good. And most people would be pleased with that number. But in my view, it's not. And they're guiding for EBITDA of 500 million in 2028, which would also be good. But again, and assuming, of course, the idea, right, is if you're gonna judge this company, say on a price to EBITDA basis, and you're saying, oh well, this company is gonna be trading at a 15 times EBITDA ratio. In 2028, if they make 500 million, take 500 million times 15, right, and you would have your enterprise value in 2028. You can do the same thing with price to sales. I usually like to think like this with price to sales. So I'm looking at price to sales right now as a 2.64. If this company still has a 2.64 price to sales in 2028, if you want to know the price of this company in 2028, it would be 2.1 billion times 2.64, and then you would get kind of your target. That's assuming the price to sales stays constant. Either way, to me, my conclusion, and I'll conclude with this, because of the blurriness that I have in the sector with the trade desk, and really what is the trade desk's positioning in this sector. The trade desk has had stellar performance. So that's point number one. And then B, coupled that with the high growth. For if you judge Zeta by all companies, they have high growth, high revenue growth. For me, they don't, because if I look at their guidance, 1.24 billion year in 2028 to 2.1 billion year in 2028. And that was 25, of course. I meant that. That's only 19.1% CAGR in sales. So you're growing the top line at 19%. You have a little bit of dilution, so let's say you have 10% dilution. So 19 minus 10, you're at 9%. You're not beating monetary inflation of 15%. So I'm a growth snob. Self-described growth snob. To me, this is not enough growth. When I look at a company like HIMS, who's growing at 60% and is much cheaper than that, right? Or when I look even at other companies I've covered on the channel, like Nebius, or there's so many of them, right? Even Oscar you could put in there. So, anyways. This is a great company, but it doesn't grow fast enough for this channel. That's the conclusion. So this was not investment advice, not financial advice. This is only entertainment. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.